Okay, we're working on exercise 18-6B. So here's the story. We've got a bookseller. This bookseller publishes romance novels that it sells to bookstores, and when it sells the book to the bookstore, the sale is made with the following terms: FOB shipping point, which basically means that the title transfers to the buyer at the time the products are shipped. We're told that the payment is made, on account, with payment due to the seller within 90 days after shipment. And the company that buys the books, the retailer, can return a maximum of 20% of an order at the retailer's cost. So if the books aren't selling for whatever reason, they can return up to 20% of the order at their initiative. We only make sales to people who have good credit ratings, of course, and based on past historical records, we find that year in and year out, although up to 20% of an order can be returned, on average the normal return rate is 16%, and it normally takes us about 97 days to collect on our receivables. Okay, so those are the basic facts, and part A and B here ask us to consider how we should account for this, and then C and D asks us to book the transaction. So in terms of A and B, how we should account for this, let's go back and let's briefly review the facts that we have, or the class discussion rather, that we had with respect to sales with right of return, because that's what we have here, is a sale with a right of return. As you will recall from our class discussion, we said that there are 6 criteria here that a sale with a right of return has to meet in order for the seller to recognize revenue at the time of the sale. We also said that normally conditions 1 through 5 will be met. The only real rub in most cases is point 6, which is whether or not the seller can reasonably estimate the amount of future returns. In our particular case here, the seller can reasonably estimate the amount of future returns. We're told that the return rate averages, 16%? 17%? 16%, there it is. Okay, so since we can estimate the amount of return, it's okay for us to go ahead and recognize revenue at the time of the sale, but we have to book an estimate, prepare a journal entry to book our estimated future returns on these sales. Just as an aside, if we had not been able to reasonably estimate the amount of return, then we would have to defer recognition of the revenue. Also, as we mentioned in class, the entry to book our estimate of the future returns involves a debit to a contra sales account called sales return and allowances. This is an offset against sales revenue on the income statement, and to have the offsetting part of that entry, the credit side of the entry, go to a contra asset account that is an offset to accounts receivable, where the name of that account is allowance for sales returns. So let's go back now to the facts of the problem in the spreadsheet, and let's go ahead and book the entry. So the amount of the sale that took place was what, $6,500,000. So we're going to debit accounts receivable $6,500,000 and credit sales revenue $6,500,000. That's the entry to book the sale. Now the next part of the entry that we need to make at the time the sale occurred is to estimate the future amount of sales returns and book that as well. We've got 2 choices here. If we wanted to be really conservative, we could use the 20% maximum return rate. That would seem to be a little excessively conservative, though, because based on historical norms, we only expect 16% of the sales to be returned. So it's probably better to go ahead and use the 16% return rate, because that's our best guess today of the dollar amount of future of these sales that will be returned in the future. So we take $6,500,000, we multiply it times this 16% return rate, and the result of that calculation gives us $1,040,000. Again, that's the 16% return rate multiplied times the amount of the sales of 6.5 million. So our best guess is that 1,040,000 out of these 6.5 million sales will be returned. So we're going to book that here by debiting that contra sales account, sales return and allowances. And offsetting credit to the contra asset account, allowance for sales returns in the same amount. Okay, so now we're in Part D of the problem. Part D of the problem rolls forward to January. Now it's January, and we're told that in January 725,000 of those sales that we made back in October were returned. So to book that, we're going to debit that contra asset, that account receivable contra asset account here, $725,000. And of course we're going to reduce our accounts receivable to reflect the fact that those buyers returned the merchandise to us and no longer owe us the $725,000. Finally, all the other people who bought the merchandise, who bought the books from us back in October, paid on account as they were required to do. So the amount of cash we got was the 6.5 million less the 725,000 returns, or we got cash of 5,775,000. So again, to reiterate, what happened in January here is out of the 6.5 million in sales, 725,000 was returned pursuant to the buyer's right of return. We reduced accounts receivable by that amount, and the remaining 5,775,000 of the $6.5 million worth of sales made back in October paid in cash as they were required to do, debit cash, credit accounts receivable.